one of the problems for the auto industry is it is potentially agreeing to a labor contract with very high rates of inflation. We're hearing other unions, airline unions in particular, getting 10 to 12% per year increases. Well, if auto prices start to go down and auto companies sign on to these big union wage increases, they're going to have a horrible time with profits. And our fear has been for years that they were going to be disintermediated, disrupted, and perhaps even destroyed by the massive shift from the internal combustion engine to electric. That's the first shift. And then even more so from human-driven cars to autonomous cars. So we're watching those negotiations. That kind of wage increase is not being corroborated more broadly. The average hourly earnings index in today's employment report was up 4.2% on a year-over-year basis and 0.2% month-to-month, so that's annualizing at roughly 2.5%. That year-over-year increase peaked at 6%, ironically, in March of 22, when oil prices shot up as Russia invaded Ukraine. And then on interest rates, again, we'll get into this with the charts, but just to explain what's happening right now. We have seen an inverted yield curve for more than a year now. I guess it was July of 2022, the yield curve as measured by the difference between the 2-year Treasury note and the 10-year Treasury bond yields, inverted July of 22, has been inverted since, and very recently and rapidly in this last, I'm going to say 3 weeks, we've been through what's called a bear steepening. What that means is short rates stayed very high, and the Fed certainly the reason for that, and long rates started moving up. So a bull steepening is when short rates come down relative to long rates. The bear steepening we've just seen is long rates moving up relative to short rates. So we've gone from more than 100 basis points inversion during the regional bank crisis in March back to roughly 30 to 35 basis points. Still inverted, still a harbinger, we believe, of recession or continued rolling recession and much lower inflation rates. But many people do not agree with that. They think it's a harbinger of a soft landing, because it is unusual at this stage for this kind of steepening to take place. We do disagree with that. We actually understand why long rates are going up. Well, first of all, there's the profligate government spending. So, the Treasury is issuing new supply of Treasury bills and bonds and notes to support the spending out there. We think that is going to die down and that most of the stimulus is behind us. But nonetheless, this is one thing the Treasury market has had to deal with. The Fed is letting its long-term and other securities roll off its balance sheet in quantitative tightening. What that means is it does not buy them back. It used to buy them back when it was in a quantitative easing mode. It is not. It's letting them roll off now. But there's another variable that most people are not discussing, but that we think is very important. And that is that the Chinese yuan and the Japanese yen are both depreciating, and both governments have expressed displeasure with this. So what does a government do when its currency is depreciating? What it does is and we believe this has happened with both China and Japan, is it sells its holdings of U.S. Dollar securities and uses those dollars, so sells the dollars and buys its own currency. And so they've been doing that aggressively, so aggressively that Chinese dollar reserves have dropped from $1.2 trillion to roughly $800 billion in the last year or so. Japan is doing the same. Now, why are they doing that? What do they fear? Well, a depreciating currency is inflationary for these economies, and it lowers the purchasing power of consumers. And in China right now, their property sector, so 75% of their savings are in the property sector, that has been demolished. Property prices down 10, 20, 40%. And it doesn't seem like that deterioration has stopped yet. So the Chinese consumer is not happy. We keep an eye on pork prices. That's the price that they really care about, a very important food staple to them. And pork prices are down, and we do believe that the Chinese government is managing those pork prices down by stimulating the supply. So the last thing China wants to see is a big surge of inflation to encourage more protests. There have been protests already because consumers are not getting back funds that they had stored on wealth management platforms in the form of effectively money market funds. These companies went way, way over the limb in terms of property investment. So you have long duration investments, short duration liabilities, and they can't return the funds. And so the Chinese consumer has become quite dissatisfied. And the last thing the government needs is an inflation problem and another hit to consumer purchasing power.